FOMC Day, Fed Day, 1 o'clock Central. If you're watching this live or before 1 p.m. Central, just a reminder, FOMC meets, releases their statement at 1 Central, and then they have their press conference at 1:30 Central. We will move. We will move to go over quickly. If they do 50, it's really bullish because it's not expected. If they do nothing, it's pretty bearish. 25% chance that they do nothing, still a surprise. Supposed to do a quarter, then the movement will be in the interpretation of the statement. Are they hawkish or dovish? Are they going to do a quarter next meeting in late October? That's what the market wants. Stock market wants another quarter in October. They want another quarter in December, quarter forever. Again, stock markets are like spoiled kids. When they want something, they'll cry if they don't get their way. Candy for kids is like low interest rates for stocks. So let's look at this morning. We had a breakout of the open that I didn't see coming, and I'm looking for a bottom, and this thing is just stuck between 98 and even. And then there was a couple things that happened. The Russell got strong. I think it was the Russell in the NASDAQ and the Dow, the three correlations that we look at, popped. And I talked about that if they can get through some of this selling edge zone, they could pop. And they pop and then come back down to it and then go up, then come back down to it, and then finally release higher, and we've never come back to it. So let me play it and kind of give you a sense of when you get through where sellers were trying to defend, then they turn to buyers to release it higher. They have the holy you-know-what moment, and that becomes the pressure to the upside. So keep an eye when you're using edge zones or any tool that you're finding to be helpful to read order flow, find where selling comes in. When they breach it is more important than recognizing when it happens. Like when the selling comes in, fine, but when they breach it, better. That's real-time reading. Now, there's no coincidence that the market comes back. These are, forget about all the numbers. Don't let it confuse you. These are up and down bars, just like those arrows. So it's no coincidence that when they get through it right in here, they rotate down a couple times to it. This becomes essentially support because the sellers, maybe who were defending it for a while, are buyers like little baby helpless birds, and they're all trying to buy it, and all these arrows create some resting bids that make support, that make the bottom of a range the bottom of a range. You got to know the definition of support and resistance and why it would work. If you don't understand that dynamic, you're not going to be able to trade it. But anyways, they rally through, they come back, use it as the bottom of the range for a couple rotations, and then drift higher eventually to the VWAP, and then the open on the session. Now it's in pause mode until 1 p.m. Central. If you watch this video before 1 p.m. Central on September 18th, just make sure, and this is for subsequent central bank, especially Fed statements, U.S. dollar is going to move in the direction of interest rates. If interest, not that the fact that the interest rates go down, they cut a quarter, so the dollar goes down, because that's priced in. There's a 73% chance they're going to do a quarter cut. So that's not the surprise. But let's say they do a quarter cut and they're dovish. Dovish means lower interest rates at some point in the future. Make sense? So if they're dovish, that lower interest rate, therefore the native currency of the central bank doing the dovishness would be the U.S. dollar, right? So the U.S. dollar would go down if indeed the statement is dovish. Now, if you don't have data for the U.S. dollar, but you have data for the 6E, which is the euro futures, and it's versus the U.S. dollar, all right, then look at the euro as opposite, meaning the euro is going to go straight up if the dollar goes straight down. So if you get a big spike in the euro, generally that means the dollar's taking the statement as dovish, stocks are going to like it and go up, bonds are going to like it and go up. This is a moment when stocks and bonds trade the same direction. Someone might say, why is that, Anthony? Well, interest rates get priced in opposite of bond prices. So bond prices go down. That means the yield within that instrument goes up. So bond prices go lower, yields go higher. Bond prices go higher when yields go lower. So if it's dovish, which is rhetoric that it's a lower interest rate environment, bond prices got to go up to price and lower yields, and stocks go up because they're like spoiled brats. They're getting more candy. They're getting what they want. So it's central bank ease all around the globe. If they do nothing, look for some bearish markets and look for Trump's head to explode.